Indra Abeysekera. One of the learning goals in this workshop is to understand two ways of recording goods purchased for sale. There are merchandising or retail companies that buy goods for sale. In those instances, those goods can be recorded in two ways. One is called perpetual system, the other one is called periodic system. Under the perpetual system, any goods bought for sale is recorded in the inventory account. Inventory is an asset account. So there can be inventory that's remaining at the beginning of the year. Let's say it's $20 and bought during the year $100 together becomes $120 of inventory. And during the year, maybe some of this inventory was sold out. When it was sold, the cost of goods sold, let's say it's $80, is transferred into the cost of goods sold account. So at the end of the period, the remaining inventory is 120 less 80, and that is $40. Under the perpetual inventory system, every time the goods are being sold, inventory decreases, cost of goods sold increases. Every time inventory is being updated and cost of goods sold is being updated. Let's compare that with the periodic system. Any goods that's purchased for sale are recorded not in the inventory account, in a separate account called purchases. So even the inventory at the beginning that is unsold is transferred into this purchases account. So the purchases in the current period is 100 and purchases unsold from the beginning of the period is 20, together is 120. So during the reporting period, some of these goods were sold, let's say $80, and the remaining inventory, remaining amount becomes 120 minus 80 becomes 40. The difference here is every time the goods are being sold, the cost of goods sold is not updated. So the cost of goods sold is zero. Only time that it is been updated is at the end of the reporting period. At the end of the reporting period, looking at the total cost of goods sold, then purchases are decreased and the cost of goods sold are increased. And the remaining purchases are transferred to the inventory account. So the difference between the two is under the perpetual system, the goods bought are recorded under inventory. Under the periodic system, goods bought are recorded under purchases. Under the perpetual system, every time the goods are being sold, inventory is decreased and cost of goods sold increase. But under the periodic system, that does not happen until end of the period. Only at the end of the period, purchases are decreased and cost of goods sold are increased.